All right, let's jump right in. Today we're tackling The Intelligent Investor by the one and only Benjamin Graham.
A classic.
Yeah. And to guide us, we've got excerpts straight from the book, plus we've got Jason Zweig's commentary to add some extra layers.
Always helpful.
Definitely. Our mission, should we choose to accept it, is to really extract those core principles.
The timeless stuff.
Exactly, those timeless principles, and figure out how can we actually use them in today's market.
Which is,
Yeah.
always a challenge.
Oh, absolutely, because things change so rapidly.
Yeah, but, Graham's work is interesting because it's not just about, here's how to pick stocks.
Right.
It's more like, let's totally change how we think about investing altogether,
He really wanted to elevate it.
Totally. Make it a thinking person's game.
Yeah, bring that analysis, that discipline to it.
Because back then, it was kind of like the Wild West.
Right. More speculation than actual investing.
Totally. And his own story kind of shows why he thought that way.
Okay, I'm all ears.
So early on, he scores this 250% return on Salopal Tire. First day of trading.
Whoa, beginner's luck.
You'd think so, right? But here's the kicker. Just a few months later, total fraud. The whole thing. Stock goes to zero.
Ouch.
Yeah, so that really solidified his whole, look beyond the hype thing.
Because you can get caught up in the excitement,
Right.
and everyone thinks they're going to make millions.
Absolutely. So that lesson probably stuck with him.
Big time, I bet.
And it led to this distinction he makes between investment and speculation.
Which, I gotta admit, sometimes seems kind of blurry to me.
So for Graham, it's all about analysis, right? Investment is like you're buying a piece of a business.
You're in it for the long haul.
Exactly. You're not just chasing a ticker symbol.
You're looking at their balance sheet, their business model, all that good stuff.
Exactly. While speculation is, it's more about trying to predict what's going to happen next.
Riding the wave, hoping for the best.
Exactly. Without necessarily understanding, the actual company.
So, with investment, you're actually sailing the ship.
Yeah, you're the captain.
But with speculation, you're kind of just along for the ride.
Yeah, maybe hanging on to a life raft, hoping you don't get tossed overboard.
Not the best strategy. Now, I've got to ask about this Mr. Market idea.
Yeah, Mr. Market.
Because I hear it all the time, but I'm not sure I fully grasp it.
Okay, so imagine this. Mr. Market comes to you every day, right? Wants to buy or sell your stock.
Like a door-to-door salesman.
Kinda. But here's the thing. He's super emotional.
Moody.
Oh, yeah. Some days, he's ecstatic, offering you way more than your stock is worth.
Like irrationally exuberant.
Totally. But other days, he's a total downer, wants to sell you everything for pennies.
Oh, so he's like the market itself personified.
Exactly. Full of those human ups and downs.
So the intelligent investor
Doesn't get swept up in the drama.
doesn't let Mr. Market's emotions rule their decisions.
Exactly. You got to see through those mood swings and make your own calls based on, research.
Okay, so practically speaking, how do we do that? How do we spot when Mr. Market is being, a little crazy?
Well, there's some things you can look at, like the price to earnings ratio.
The PE ratio.
If that's way higher than usual, could be a sign that Mr. Market's got rose-colored glasses on.
So optimism isn't always a good thing.
Not when it's not grounded in reality, right?
Yeah.
Another thing to check is the book value.
Right.
Basically what the company's assets are actually worth, like if they sold everything off today.
Okay, got it.
So if the stock price is way higher than that, could be another red flag.
Like the market's baking in a whole lot of future success that might not even happen.
Exactly. So you got to be like that calm observer,
Keeping your cool amidst the chaos.
Right. Looking for those times when you can buy low, sell high.
Sounds simple in theory.
It is. The hard part is actually doing it.
Because, let's be honest, emotions can get in the way.
All the time. That's where discipline comes in.
Right. Which leads us to another big idea. Margin of safety.
Oh, yeah, that's a good one.
Because everyone wants a bit of a cushion, right? Especially when it comes to their money.
Absolutely. And that's what the margin of safety is all about.
Okay, break it down for me.
It basically means you never overpay, even for companies you love.
Even if you're super confident.
Exactly. Because you got to admit, there's always a chance you could be wrong, right?
Or that something totally unexpected could happen.
Exactly. The market's full of surprises.
So the margin of safety is like acknowledging that we don't have a crystal ball.
Totally. You're building in that buffer just in case.
So you're not wiped out if things go south.
Exactly. It's like buying $1 for 50 cents,
So there's room for error.
Yeah, and that ties into being a critical thinker, which Graham talks about a lot.
Like, don't just believe everything you hear.
Especially on Wall Street, right? Do your own digging, Question those assumptions.
Don't just follow the herd.
Exactly. And along with that, he's big on discipline and courage.
Which are kind of two sides of the same coin, right?
You could say that, because it's easy to get spooked when the market goes crazy.
Yeah, you want to sell everything when prices drop.
And then buy back in when everyone's feeling good again.
Which is usually the worst time to do it.
Exactly. So the intelligent investor, they stay the course.
They stick to their plan.
They've got that long-term vision.
And Graham realized that not all investors are the same, right? We all have different goals.
Absolutely. That's where the defensive investor comes in.
Okay, who's that?
This is someone who's looking for, like, financial peace of mind, you know?
They're not trying to get rich quick.
No, they just want a solid portfolio that can handle the ups and downs.
Weather the storms.
Yeah. And for them, Graham recommends a specific mix of stocks and bonds.
How specific are we talking?
Between 25% and 75% in stocks.
Okay, so there's some flexibility there.
Yeah, you find what works for you, but the key is to rebalance regularly.
Meaning?
So, like, if the stock market goes up a lot and your stock portion gets too big.
You sell some off and buy more bonds.
Exactly, to keep that balance, that risk level where you want it.
So it's a way to stay disciplined, not get too greedy.
Exactly, because greed can get you in trouble.
For sure. Now, what about bonds? Where do they fit into all of this?
So Graham saw bonds as that steady eddy,
Yeah.
you know, providing that stable income.
Yeah, like a rock in the storm.
Exactly. And he said there are lots of different types, but for most folks,
Bond funds are the way to go.
yeah, easier to manage.
Less risky too, right?
Because you're spreading your money across a bunch of different bonds.
Diversification, gotta love it.
Exactly. So you're not putting all your eggs in one basket.
Now, even though Graham was all about that steady approach,
He wasn't completely against growth stocks.
because who doesn't love the idea of their investments skyrocketing?
Right, but he was very cautious about them.
In what way?
He was worried about people overpaying for that potential, you know?
Like getting caught up in the height.
Exactly. So he uses this example of A&P, the grocery store chain.
Okay.
So their earnings were pretty stable, right? But the stock price was all over the place.
That doesn't make sense.
It didn't. It was completely disconnected from what the business was actually doing.
So the market was just like making stuff up.
Pretty much. Driven by emotions, rumors, all that.
But a less a case of irrational exuberance.
You got it. And that's why Graham was so big on, like, valuing things rational.
Yeah, looking beyond the hype, right?
Exactly. So for the defensive investor, how do they pick stocks?
Well, he warned against just buying what you know.
Ah, yeah, that's a classic trap.
Because you think, oh, I love their coffee, so their stock must be a good buy.
Right, but that's not always the case.
You got to separate your personal feelings from the actual business.
Exactly. So even if it's a company you're familiar with,
You still got to do your research.
thorough research, look at the numbers, understand what they do, all of that.
Don't just assume because they make a good product that they're also a good investment.
Exactly. And to prove his point, he compares Cisco, the tech darling at the time,
Oh, yeah, everyone was talking about them back then.
to Cisco, the food distributor.
Interesting. Totally different industries.
Right. But guess who outperformed in the long run?
Not Cisco.
Nope, it was Cisco, showing that sometimes those less exciting businesses,
Can be the real winners.
yeah, slow and steady wins the race. Right.
Now, I've got to ask about market fluctuations because those can be scary.
Especially for new investors.
Exactly. You see your portfolio dropping and you panic.
Yeah, but Graham's point was those fluctuations are normal.
They're part of the game.
Exactly. And he actually saw them as opportunities.
Opportunities, how so?
Because when prices drop, that's when you can buy low.
Ah, so it's like a sale at your favorite store?
Kind of.
Yeah.
But you got to have the courage to buy when everyone else is selling.
Which is easier said than done, right?
It definitely takes practice and a lot of trust in the process.
Because you got to believe that the market will eventually recover.
Right. You got to have that long-term perspective.
Okay, so we're not trying to time the market. We're just riding the waves.
Exactly. And that's a key difference between the intelligent investor and the not-so-intelligent investor.
The ones who get caught up in the hype and make emotional decisions.
Exactly. Now, let's talk about mutual funds, because those are often touted as a good option for the average investor.
Right. They seem simpler than picking individual stocks.
They can be, but Graham was a bit skeptical of them.
Why is that?
He saw a lot of them, even with those professional managers.
Not beating the market?
Nope. And he was worried about those high fees eating into your returns.
So he wasn't a fan of the whole actively managed thing?
Not really. He preferred index funds.
Index funds, why those?
They're low cost and they just track the market, you know.
So you're not trying to beat the market. You're just going along for the ride.
Exactly. but in a good way.
Makes sense. So you're not paying all those extra fees for someone to try and pick winners.
Right, and historically, index funds have done pretty well, especially over the long term.
Interesting. Now, Graham also emphasized something that I think gets overlooked a lot: investor management relations.
Yeah, that's an important one.
Because ultimately, you're trusting the people running the company with your money, right?
Absolutely. So
Right.
you got to ask, are they acting in the best interests of the shareholders?
Which isn't always the case,
No,
unfortunately.
it's not. So Graham said, look for companies that are transparent.
They're open about their performance, they communicate clearly.
Exactly. And they're responsive to concerns. They listen to their shareholders.
So it's about accountability, right?
Totally. And Graham actually encouraged shareholders to get involved.
Like, don't just sit on the sidelines.
Yeah, vote on those proxies, go to the meetings, make your voice heard.
Okay, so be an active owner, not just a passive investor.
Exactly. Now, what about stock repurchase plans? Those are popular these days.
They are. So what did Graham think of those?
He thought they could be good, but only if done right.
Okay, what does that mean?
So when a company buys back its own stock,
They're essentially reducing the number of shares out there.
exactly, which can boost the value of the remaining shares.
Ah, so everyone wins.
Well, potentially. But Graham was wary of stock options.
Why is that?
He felt they could incentivize managers to do buybacks even when it wasn't the best move for the company.
Well, like to boost the stock price in the short term, even if it hurts the company long term.
Exactly.
Yeah.
So it's another reminder to really understand what's going on behind those corporate actions.
Don't just take things at face value, dig a little deeper.
Exactly. And that brings us back to, you guessed it, the margin of safety.
Ah, our old friend.
Because like we said, no one can predict the future, right?
Even the so-called experts.
Nope. So that's why buying below intrinsic value with that margin of safety.
It's like having that extra layer of protection.
Exactly. It protects you if your analysis is off, if something unexpected happens.
Because things happen, right, all the time.
Oh, yeah. So the margin of safety, it limits your downside.
So you don't lose everything.
Right. And it also means that if things go better than expected.
Your returns are even bigger.
Exactly. It's like a built-in bonus.
Okay, I like the sound of that.
And to really hammer this home, Graham talks about JDS Uniface.
Oh, yeah, that was a wild ride.
It was. Their market value was insane, even though they were losing tons of money.
So people were just caught up in the hype.
Totally. And eventually the bubble burst, and everyone who bought at the peak.
Lost a lot of money.
Yeah, it's a classic example of what happens when you ignore the fundamentals.
And get swept up in the speculation.
Exactly. So the margin of safety, it's not just about being cautious. It's about being smart.
It's about protecting yourself.
And it's really at the core of Graham's whole philosophy.
Yeah, it seems like that's a theme that runs through everything he talks about.
It definitely does. And it's a good reminder for all of us, no matter how experienced we are.
Because the market can be unpredictable.
Oh, yeah. And you never know what's going to happen next.
So be prepared, do your research, and always have that margin of safety.
Words to live by. It is. And, you know, another thing Graham warned about a lot was this idea of performance chasing.
Oh, yeah, always trying to find that next hot stock.
Right. Like it was a problem even back then.
It's timeless, that allure of easy money.
Oh, yeah. And it never really goes away, does it?
Nope, we see it over and over again, like in the 60s.
The go-go year.
Yeah, or the dot-com bubble in the 90s.
Oh, yeah. And even today you see it with certain trends.
Like everyone piles into whatever's hot.
And then, surprise, the bubble bursts.
It's like people forget history or think this time it's different.
Right. But Tram's like, nope. Those cycles, they always come back around.
So how do we avoid falling into that trap? How do we tell what's a real opportunity versus just pure hype?
Well, he says, focus on the fundamentals.
Okay, back to basics.
Exactly. Tune out the noise. Look beyond those short-term price swings.
Look at the actual business, right?
Exactly. What's their business model? Are they making money?
Are they actually solving a problem, or are they just like a story?
Exactly. A good story can only take you so far.
For sure. So no shortcuts. Got to do your homework.
Right. And along with that comes patience and discipline.
Ah, those are tough ones.
They are. But Graham's like, look, building wealth, it takes time.
No get-rich-quick schemes.
You know, it's a long game.
Like planting a tree.
Exactly. You got to nurture it, give it time to grow.
And not freak out every time the wind blows.
Right, because market downturns, they're going to happen.
They're inevitable part of the cycle.
Exactly. And Graham says, don't be afraid of them.
Don't panic, Sal.
No. In fact, he saw downturns as buying opportunities.
Ah, so like a sale.
Exactly. Because the market overreacts both to good news and bad news.
So when everyone's freaking out,
That's when you can find some real bargains.
if you have the stomach for it.
Right. It takes guts, but that's where the big rewards can be.
Okay, now what about IPOs, those initial public offerings?
Oh, yeah, those are tempting.
Because everyone wants to get in on the ground floor, right?
Totally. But Graham was pretty skeptical of them.
Really? Why is that?
He saw a lot of them as being overpriced, driven by hype.
So not always the golden ticket they seem to be.
Nope. And those investment banks, they want to make sure those IPOs sell.
So they price them high.
Yeah. Which leaves less room for regular investors to make money.
Ah, so buyer beware.
Exactly. Do your research. Don't get caught up in the excitement.
Okay, good advice. Now let's talk about something that can be a bit intimidating. Financial reports.
Oh, yeah. Those can be a bit dense.
Balance sheets, income statements, all that stuff.
But Graham thought every investor should at least understand the basics.
Like, you don't need to be an accountant.
No, but you should know what you're looking at.
So it's like reading a company's medical chart, in a way.
Exactly. You got to know their vital signs, see if they're healthy.
Are they in good shape, or are they hiding something?
Exactly. And Graham was big on, like, looking for red flags.
Anything that seems fishy.
Right, like those special charges or extraordinary items.
Ah, so trying to make their earnings look better than they really are?
Exactly, like putting a Band-Aid on a broken leg.
Doesn't really fix the problem.
No, it doesn't. And Graham was really good at seeing through that stuff.
So it's not just about the numbers themselves, it's about the story behind them.
Exactly. And whether that story makes sense.
Okay, now what about convertible issues? Those sound a bit complicated.
They can be. So basically, they're like a mix between bonds and stocks.
A hybrid.
Yeah, so you get that fixed income from the bond part,
Okay, that's good.
but you also have the potential for the price to go up, like a stock.
So you get the best of both worlds.
In theory, but Graham said, watch out for those downsides.
Which are?
Well, the interest rates are usually lower than regular bonds.
Okay, that makes sense.
And those conversion privileges, they can be tricky.
Like they can change the terms on you.
Yeah, it's not always straightforward.
So it's not for the faint of heart?
No, it's definitely more for the advanced investor.
Okay, so we've talked a lot about avoiding speculation.
But Graham did say there are times when a calculated risk can be okay.
Oh, interesting. Like when?
He called them special situations.
Okay, what's that all about?
So this is when a company's going through a big change, like a merger or something.
Okay, that makes sense.
And sometimes, during those times, the market price doesn't reflect the real value.
So there's an opportunity to, like, swoop in and get a deal.
Potentially, but it's risky.
Not for the average investor.
No, definitely more for those who really understand those situations.
So you got to know what you're doing.
Absolutely. It's not just about, oh, this company's being acquired, let's buy the stock.
There's a lot more to it than that.
Way more. You got to understand the terms of the deal, the financials, everything.
So it's like a specialized area of investing.
Yeah, for sure. But Graham said, if you know what you're doing,
Those special situations can have big payoffs.
potentially huge. But again, high risk, high reward.
Okay, now let's get back to the margin of safety.
Ah, yes, our old friend.
Because we talked about it earlier, but it seems so important.
It's crucial. It's like the foundation of everything.
So remind us, what is it exactly?
It's basically that buffer you build in by buying a company for less than it's really worth.
So you're getting a discount.
Exactly. And the bigger the discount, the bigger your margin of safety.
So it's like shopping at a clearance sale.
Totally. You're getting a bargain.
Okay, and why is this so important?
Well, for a few reasons. First, it protects you if you're wrong.
Because we all make mistakes.
We do. Even the best investors.
So it's like admitting that we don't know everything.
Exactly. And that things can go wrong.
So the margin of safety, it limits the damage.
Right. It's your insurance policy.
Okay, that makes sense. What else?
It also means that if things go right,
Your returns are amplified?
exactly, because you bought it for less.
Ah, so it's like a bonus on top of your profit.
Exactly.
Right.
And third, it can help you stay calm.
When the market goes crazy,
Yeah, because you know you bought it at a good price.
so you're less likely to panic sell.
Right. You're more likely to ride it out.
Okay, so it's like a psychological benefit too.
Totally. It keeps you grounded.
And Graham, he loved to tell stories, right?
Yeah.
To illustrate his points.
Oh, yeah, he was a great storyteller.
And one that really stuck with me was the one about Penn Central Railroad.
Yeah, that was a classic case.
It seemed like such a solid company.
Right. Everyone thought they were too big to fail.
But then they went bankrupt.
Yeah, in 1970, it was a huge shock.
And Graham's point was the warning signs were there.
They were. If you looked at their financials,
But people ignored them.
they got caught up in the reputation, the
That
history.
assumed everything was fine.
Right. But past performance is not a guarantee.
No, things can change, and you got to be paying attention.
Absolutely. Even if it's a company you think you know.
Okay, now what about investor psychology? Because that plays a big role too, right?
Huge role. And Graham understood that.
He knew that emotions can drive the market.
Oh, yeah. Fear and greed, they can make people do crazy things.
Like buy high and sell low.
Exactly. The opposite of what you should be doing.
So how do we control those emotions? Because they're powerful.
They are, but Graham's like, you got to be aware of them.
Recognize when they're influencing your decisions?
Exactly. And try to be more rational, more objective.
Don't let those emotions cloud your judgment.
Right, because that's when you make mistakes.
Okay, so think like Mr. Spock, not like Captain Kirk.
Exactly. Logic over emotion.
Now, one example that I found really interesting was the one about National Presto and National General.
Yeah, that one's a good illustration.
So National Presto, they made pressure cookers, pretty simple business.
Right, not very glamorous.
But National General, they were this huge conglomerate.
Involved in all sorts of stuff.
Movies, restaurants, you name it.
Yeah, they were all over the place.
And the market valued them way higher than National Presto.
Even though National Presto had a better track record.
So it was like the market was rewarding complexity.
Exactly. And Graham's like, that's not always a good thing.
Because sometimes those conglomerates, they get too big.
And they lose focus. Their managers can't handle it all.
It's like trying to juggle too many balls.
You're bound to drop a few.
And that's what happened to National General, right?
Yep, they eventually stumbled.
And their stock price tanked.
Yeah, proving that sometimes simple is better.
Focus on what you know. Focus on quality.
Exactly. Don't get distracted by the shiny objects.
Okay, now what about the relationship between investors and management?
That's a big one.
Because ultimately, you're trusting those managers with your money, right?
You are. And Graham was very clear. Shareholders, they're the owners.
They're not just passive bystanders?
Nope. They have rights, and they should hold management accountable.
So how do we do that?
Well, Graham said, vote on those proxies.
Those are the proposals that companies send out, right?
Yeah, and go to the annual meetings, ask questions.
Don't be afraid to speak up.
Exactly. And if you're not happy with how things are being run,
You can sell your shares.
you can. You have that power.
Okay, so we're not powerless. We have options.
Exactly. And Graham was a big believer in using those options.
Yeah. Now, let's talk about stock repurchase plans.
Those are popular these days.
They are, so what did Graham think about them?
He thought they could be good, but only if done for the right reasons.
Okay, what does that mean?
So, when a company buys back its own stock,
It reduces the number of shares out there.
right, which can make the remaining shares more valuable.
Okay, so it's like a stock split, but in reverse.
Kinda, but Graham's point was, sometimes companies do buybacks,
Not because it's good for the company.
but to manipulate earnings or boost the stock price temporarily.
So they're playing games.
Exactly. And that's not good for long-term investors.
So it's another reminder to be skeptical, to look beyond the headlines.
Right. Understand the motivation.
Now, Graham also had some thoughts on inflation.
Oh, yeah, that's a big one, especially today.
Because it erodes your purchasing power, right?
Exactly. Your money doesn't go as far.
So how do we protect ourselves from that?
Well, Graham said you need investments that grow faster than inflation.
Makes sense, otherwise you're losing ground.
Exactly. And he thought stocks were better for that than bonds.
Why is that?
Because companies can raise prices to keep up with inflation.
So they have more flexibility.
Exactly. While bonds, you're stuck with that fixed interest rate.
So even if inflation's high,
You're still getting the same low return.
not good. So stocks can be a better hedge.
Over the long term, yeah, but of course there's always risk.
Right, no guarantees.
Never are. But Graham said, gotta factor inflation into your decisions.
Okay, so don't just look at the nominal return, look at the real return.
Exactly, after inflation is taken into account.
Makes sense. Now what about market timing? Did Graham believe in that?
Not really. He thought it was more like speculation.
Trying to guess what the market's going to do next.
Yeah, and he said even the pros are terrible at it.
So no one can really predict the future.
Nope. And Graham said, instead of trying to time the market.
Focus on time in the market.
Exactly. The longer you're invested.
The more likely you are to come out ahead.
Right, because the market tends to go up over time.
Despite those short-term ups and downs.
Exactly. So be patient. Ride it out.
Okay, now what about dividends? Where do they fit into all of this?
So Graham saw dividends as a good sign, you know.
Like a company sharing its profits with its owners.
Exactly. And he said they can provide a nice stream of income.
especially for retirees.
Yeah, or anyone who needs that extra cash.
But he also warned about dividends that are too high,
Oh, yeah, because sometimes companies pay dividends.
even when they can't really afford it.
Right, like they're trying to impress investors.
But it's not sustainable.
No, it's like spending more than you earn.
Eventually, you run out of money.
Exactly. So Graham said, look for companies with a history of...
Consistent, sustainable dividends.
Yeah, that's a sign of a healthy business.
Okay, makes sense. Now let's talk about debt.
Ah, debt, the four-letter word.
Everyone's favorite topic.
Right. But Graham was very clear. Debt, it can be dangerous.
Especially for companies.
Oh, yeah. If they take on too much...
It can weigh them down.
Exactly, and make them vulnerable.
Like if there's a recession or something.
Right. Suddenly they can't make those payments.
When they go bankrupt.
Exactly. So Graham said, when you're looking at a company...
Don't just focus on their earnings.
No, look at their debt too.
How much do they owe and can they handle it?
Right. Those are the key questions.
Okay, so debt's not always bad.
No, but you got to be smart about it.
Now, what about using debt to invest? Leverage, they call it.
Yeah, that's a whole other topic.
But yeah, the risk of your
Very risky. Graham said it can amplify your gains.
but also your losses.
Exactly. So he was very cautious about it.
Not for the average investor.
Definitely not. It's more for the pros.
The ones who really know what they're doing.
And even then, it's dangerous.
Okay, so leverage. Use with extreme caution.
Or avoid it altogether.
Now, what about investment advisors? There are so many out there.
Oh, yeah. It can be hard to choose.
Especially with all those ads promising huge returns.
Right. So Graham said, be skeptical.
Don't believe the hype.
Exactly. Look for an advisor who's trustworthy.
Someone who's focused on your long-term goals.
Right. Not just on making a quick buck.
So they should be more like a teacher.
Yeah, educating you, not just selling you something.
Okay, so do your research, ask questions.
Lots of questions. Don't be afraid to grill them.
Now, we talked about psychology earlier, but it's worth mentioning again.
Because it's so important.
It really is. Those emotions can really mess with your investing.
Oh, yeah. Fear and greed, they can make you do irrational things.
Like sell when you should be buying or buy when you should be selling.
Exactly. And Graham was like, the intelligent investor.
They recognize those emotions, but they don't let them control them.
Right. They make decisions based on logic.
Not on how they're feeling at the moment.
Exactly. And that's where that margin of safety comes in handy again.
Ah, our old friend.
It's not just a financial buffer, it's an emotional buffer too.
It helps you stay calm when everyone else is freaking out.
Right. And that's when you can make the best decisions.
Okay, so we've talked a lot about analyzing individual companies.
But Graham also said, don't forget about the big picture.
The overall economy.
Exactly. Those macroeconomic trends.
Things like inflation, interest rates, all that stuff.
Yeah, because those things can have a big impact.
On the whole market.
And on individual companies, too.
So you got to be aware of what's happening in the world.
Right. It's all connected.
Okay, now let's talk about diversification.
Ah, diversification. The key to reducing risk.
Don't put all your eggs in one basket, right?
Exactly. Spread your money around.
Different asset classes, different industries.
Yeah, because if one investment goes bad...
It won't wipe you out.
Right. You've got others to cushion the blow.
Okay, so diversification, it's like insurance for your portfolio.
You could say that. It's a must-have.
Now, what about technical analysis? All those charts and patterns.
Oh, yeah, that stuff.
Did Graham believe in that?
Not really. He thought it was more like reading tea leaves.
Trying to predict the future based on random squiggles.
Yeah, he said those patterns might be interesting.
But they don't really tell you anything about the future.
No, they don't. And he said the real value of a company
Comes from its fundamentals.
Exactly, not from some chart pattern.
Okay, so stick to what you can measure and analyze.
Right, don't get lost in the weeds.
Now, what about preferred stocks? Those seem to fall somewhere between stocks and bonds.
They do, they're kind of a hybrid.
So what's the appeal?
Well, they pay a fixed dividend, like a bond,
Okay, that's nice.
but they also have the potential to go up in price, like a stock.
So you get a little bit of both.
Yeah, but Graham said, be careful.
Why is that?
Well, those dividends are usually lower than bond yields,
Okay, that makes sense.
and the prices can be more volatile than bonds.
So they're not as stable.
No, they're not. So he said, not really for the defensive investor.
Okay, more for the risk takers.
Right, the ones who are comfortable with more uncertainty.
Now let's talk about growth stocks. Those are popular these days.
Oh, yeah, everyone wants to find the next Amazon.
The next big thing.
Right, and Graham understood that.
He knew those companies had potential.
Big potential. But he was very cautious.
In what way?
He said, don't overpay for that growth.
Because it might not materialize.
Exactly. And even if it
Just
did,
pay too much up front.
your returns will be lower.
So it's all about finding that balance.
between growth and value.
Right, not just chasing the hype.
Exactly, because hype can be dangerous.
It can lead to bad decisions.
For sure.
Yeah.
Now, what about investor relations? How companies communicate with their shareholders?
That's an important one because you gotta trust the people running the company.
Absolutely. And Graham said transparency is key.
Open and honest communication.
Exactly. No secrets, no hiding things.
So investors should be wary of companies that are secretive.
Oh, yeah. If they're not willing to be open.
It's probably a red flag.
It could be. Yeah. Look for companies that hold regular meetings.
Answer questions, address concerns.
Right. They treat your shareholders with respect.
Okay, so transparency is a good sign.
It is. And speaking of good signs,
What about management? How do we evaluate that?
well, Graham said, look for experience.
People who've been there, done that.
Right. And competence. They know what they're doing.
And ethics, that's important too.
Crucial. You don't want crooks running the show.
So it's like doing a background check on the management team.
Exactly. Read their bios, listen to their interviews,
Get a feel for who they are.
and whether you trust them.
Okay, now let's talk about value investing versus growth investing.
That's a big debate.
And Graham was a big proponent of value investing.
Oh, yeah, that was his thing.
So what's the difference?
Value investing is all about finding those undervalued companies.
The ones the market's ignoring.
Exactly. You're looking for bargains.
While growth investing,
Is more about finding those companies with high growth potential.
even if they're expensive.
Right. You're bidding on the future.
And Graham felt that value investing was safer.
Yeah. More margin of safety.
Okay, makes sense. Now, we've talked a lot about being rational.
But emotions, they play a big role too.
Oh yeah, they can really cloud your judgment.
For sure. And Graham knew that.
He said, fear and greed, they can drive the market.
Up and down. Yeah, creating those swings.
So the intelligent investor.
Recognizes those emotions, but doesn't get swept up in them.
Right, you got to stay calm, stick to your plan.
Exactly. Don't let the market dictate your actions.
Okay, so it's like a mental game as much as a financial one.
It is. You got to be mentally tough to succeed in the market.
Now, another big theme in Graham's work is patience.
Oh, yeah. Patience is key.
But it's hard. Everyone wants instant gratification.
I know, right?
Yeah.
But Graham's like, look, building wealth, it takes time.
It's not a sprint, it's a marathon.
Exactly. And the more patient you are,
The more likely you are to reach your goals.
because the market, it rewards those who are patient.
Okay, so slow and steady wins the race.
Exactly. Now, what about luck? Does that play a role?
Everyone wonders that, right? How much of it is skill versus just being lucky?
Well, Graham said luck definitely exists.
Good luck and bad luck.
Exactly. But he thought that over time.
Skill and discipline matter more. So it's not just about being in the right place at the right time.
No, it's about making smart decisions consistently.
And those decisions will compound over time.
Exactly. And that's where Graham's principles come in.
They give you a framework for making those smart decisions.
Right. So even if you have some bad luck along the way,
You'll still be okay.
you'll be better prepared than someone who's just winging it.
Now, we can't talk about Graham without mentioning Warren Buffett,
Yes, his most famous student.
the Oracle of Omaha.
He was a big fan of Graham's work.
And he's proof that those principles work.
Oh, yeah. Buffett's success is a testament to Graham's genius.
Okay, so if it worked for him, it can work for us.
Potentially. But you got to put in the work.
No shortcuts.
Nope. Investing is a serious business.
And it requires a certain mindset.
A long-term mindset.
Right, and a willingness to learn and adapt.
Because the market's always changing.
Now, Graham also talked about ethics in investing.
Oh, yeah. That was important to him.
Because it's not just about making money.
No, it's about doing it the right way.
Being honest, being fair.
Exactly. He said integrity is crucial.
So don't cut corners, don't cheat.
No, those things will come back to bite you.
Okay, so invest with integrity.
That's the Graham way.
Now, in today's world, it's easy to get distracted.
Oh, yeah. There's so much noise out there.
Social media, news, everyone's got an opinion.
And it can be overwhelming.
So how do we stay focused?
Graham said, tune out the noise.
Focus on what matters.
The fundamentals, the long-term trends.
Don't get caught up in the day-to-day swings.
Exactly. Think for yourself.
Don't just follow the crowd.
Right, because the crowd is often wrong.
Okay, so be a contrarian, be independent.
That's the key to success in the market.
Now, what about the role of government?
That's a big one.
Always a lot of debate about that.
Yeah, so Graham said government has a role to play.
But it shouldn't be too intrusive.
Exactly. They need to protect investors.
From fraud, from abuse.
Right, but they also need to let the market do its thing.
So it's about finding that balance.
Regulation versus free markets.
Right. And Graham thought the best way to protect investors
Was through education.
Teaching people how to make smart decisions.
Exactly. And by enforcing those laws against fraud.
So bad actors get punished.
Right. That's important.
Now, one of Graham's most famous quotes.
In the short run, the market is a voting machine.
But in the long run, it is a weighing machine.
Love that quote.
What do you think he meant by that?
He's saying, in the short term.
The market is driven by emotions.
Yeah, people voting with their gut feelings.
But in the long term,
the market weighs the evidence.
The fundamentals, the actual performance.
Exactly. So don't get caught up in the short-term noise.
Have that long-term perspective.
That's where the real money is made.
Okay, now what about having a written investment plan?
Oh, Graham was a big believer in that.
Why is that?
He said, it helps you stay disciplined.
Especially when the market's going crazy.
Yeah, you're less likely to make those emotional decisions.
So it's like a roadmap for your investments.
Exactly. It lays out your goals, your risk tolerance.
Your asset allocation, all that good stuff.
And you should review it regularly.
Make sure it's still aligned with your situation.
Right, because things change.
Life throws you curveballs.
It does. And your investment plan should adapt.
Okay, so have a plan, but be flexible.
Exactly.
Yeah.
Now Graham also talked about something called market risk.
Which
basically the risk that the whole market could go down.
So even if you pick good companies.
You could still lose money.
Yeah, because the tide can take all boats down.
Exactly. And Graham said that's just part of investing in stocks.
There's no way to avoid it completely.
Nope. But he said, over the long term,
the market tends to go up.
Right. It's like a staircase with some steps down along the way.
But overall, it's heading upward.
Exactly. So the key is to have a long-term perspective.
Don't panic when there's a dip.
Right. Those dips, they're buying opportunity.
Correct. Now, for younger investors especially.
The power of compounding, it's huge.
Yes, compounding. The eighth wonder of the world.
That's what Einstein called it.
He knew a thing or two about complex stuff.
I think he did. And compounding is basically
earning interest on your interest.
Exactly. So your money grows faster and faster.
Like a snowball rolling downhill.
Exactly. And the sooner you start,
the bigger that snowball gets.
Right. So even if you can only invest a little bit,
it's worth starting now.
Absolutely. Time is your friend.
Okay, so invest early, invest often.
That's the key to long-term success.
Now, Graham also said it's important to stay informed.
About your investments, yeah.
Like, don't just buy stocks and forget about them.
No, you got to keep up with what's going on.
Read those annual reports, track the news.
Exactly. Be an active owner.
Don't just be a passive passenger.
Right, because things change.
Companies change, the market changes.
And you got to be ready to adapt.
Okay, so stay informed, stay engaged.
Exactly. Now let's talk about taxes.
Ugh, everyone's favorite topic.
Right. But Graham said, you got to be aware of the tax implications.
For your investments.
Because taxes can eat into your returns.
Big time. So what can we do about that?
Well, Graham said, use those tax-advantaged accounts.
Like IRAs and 401k.
Exactly. Because those allow your money to grow.
Tax-deferred or even tax-free.
Right, so you're not paying taxes until later.
Okay, so that's a big advantage.
It is. It can make a big difference in the long run.
All right, so we've covered a lot of ground here.
We have. Graham's book, it's packed with wisdom.
And even though it was written decades ago,
those principles, they're still relevant today.
Maybe even more so with all the distractions we have now.
So let's recap some of the key takeaways.
Okay, give us the Cliff's Notes version.
First, remember, a stock is a piece of a business.
It's not just a ticker symbol.
No, it represents ownership in a real company.
So invest in companies you understand, companies you believe in.
Exactly. And second, always seek that margin of safety.
Buy with a discount, never overpay.
Right. That's your protection against the unknown.
Third, be patient, be disciplined.
Investing is a marathon, not a sprint.
So don't get discouraged if you don't see results immediately.
It takes time for those investments to grow.
Fourth, diversify your portfolio.
Spread your risk. Don't put all your eggs in one basket.
Right, because you never know what's going to happen.
Exactly. And fifth, control your emotions.
Fear and greed, they're your enemies.
So make decisions based on logic, not on your feelings.
Okay, so stay calm, stay rational.
Exactly. And finally, never stop learning.
The market's always changing, so you got to stay ahead of the curve.
Read books, talk to experts, do your research.
Great advice, and remember, everyone,
this is just a taste of what Graham has to offer.
So if you're serious about investing,
read the book. It's worth it.
All right, well, that's all the time we have for today.
Thanks for having me.
It was a pleasure, and thanks to all of you for listening.
Happy investing, everyone.
We'll see you next time.